Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Chris Versace, co-founder, chief investment officer, and thematic strategist at Tematica Research, to discuss the promise of AI versus the current state of its end markets in near-term earnings prospects. Chris, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me, Jill.
All right, and a key piece of earnings coming out this week on Wednesday, of course, is NVIDIA, and investors will be looking to see, are we at peak hike, or is this really something that's going to be longer lasting?
Yeah, I think it's a great question. AI is just one of the more recent disruptive technologies. We've had a host of them. Perhaps you've heard of something called the internet, but other things like 3G, 4G, and the like. And invariably, what we've seen time and time again is that the expectations get out over the skis. And when we look at shares of NVIDIA, but also more recently Google, Microsoft, and the like, there's a lot of expectation on the promise of what AI might bring. But I think when NVIDIA reports, it's going to tell us what's going on in its end markets, i.e. data center, graphic cards, the gaming market and the like. And this might be a little bit of a sobering moment for investors. Having said that, do I think that there is some longer term promise for AI? Absolutely. Again, you take a look at some of the ones that I rattled off, particularly the internet. If you were to compare it to today versus what we saw back in 1999, 2000, were we streaming? Were we doing payments? Were we doing all these things that we take for granted today? No. So there will be some positive disruption. I just think in the near term, it's a little overdone.
Let's talk about the debt ceiling for a moment here. Should investors be concerned about this? It doesn't seem as if any progress has been made. If anything, we're at a cliffhanger here.
Yeah, I mean, as we're taping this, my understanding is that Biden and McCarthy are going to talk, 4:30, 5:30 tonight. Hopefully, we'll kind of get, the logjam will be broken free. My suspicion is that, especially ahead of an election year, they really don't want to have any major issues being able to, point the finger at each other. I've been thinking all along that we would get an 11th hour deal. That increasingly looks likely, but I will counterbalance that by saying, Jill, the bottom line is, we need to know the details of any deal that we get, especially if it only kicks the can down the road 3 months, 4 months, 5 months, in which case we're doing this all over again. So a lot's going to hinge on what we learn and those details.
Right. And of course, a lot's going to hinge on Fed action going forward. The market seems to want a rate cut here, but from I can tell with the language, perhaps there's a pause, but they haven't been talking about cuts.
No, I think you're 100% right. There are a couple key messages that came out of last week with the gaggle of Fed heads that we had, and we have more, this week as well. But the message was that maybe it's a pause, maybe there's a little more policy tightening to be had down the road. But the one thing that almost across the board everybody said is no rate cuts in the second half of 2023, and yet the CME Fed Watch tool continues to show 2 to 3 rate cuts in the back half of the year. And I think the market really needs to wrap its head around the fact that the Fed is going to stick to what they're doing. Just look at some of the recent inflation data, core CPI between 5.5 and 5.7% for the last 4 months. We've got more data coming, but it's still a long road to 2%.
Yeah, I'd be surprised if we got any cuts at all, let alone 2 to 3. Let's talk about what's happening in the banks now. Is there still a concern out there for the regional banks, or do you think this is somewhat under control at this point?
It seems to be improving. We heard some news last week that at some regional banks, deposits are starting to flow. We take a look at what PacWestern had to say earlier today, again, kind of cleaning up its balance sheet. And then, of course, more Fed heads coming out and saying, the worst is over. Now, I do understand that they kind of have to be cheerleaders, for the economy and for moments like this. So we take the Fed comments a little bit of, grain of salt here. But the action that we're seeing, I think, says things are continuing to affirm, continuing to improve. Personally, we continue to like the larger banks, Bank of America in particular. We see them benefiting from that flight to quality, just as any lingering questions remain.
And finally, I want to wrap up and talk about the consumer here. You pointed out that it's Forward Capital Markets Day and that the consumer is increasingly more selective.
Yeah, I mean, we saw that last week in spades from, Walmart, Target, Foot Locker even, and we have a lot more retailers coming out this week reporting. So we'll be able to fine tune that. But my concern with Ford is that, how do you recognize all the synergies that you're talking about on the cost side if volumes may not be as strong as you're thinking? And the other concern that I have is after the company reported its March quarter, if you parse the guidance over the next few quarters, there's not a lot of profit growth to be had. So I think this is perhaps a longer term story. And the big risk is if these volumes don't appear, that transition may not unfold as fast as some people are hoping.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.